Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Steve Wyett, Chief Investment Strategist at BOK Financial, as well as Steve Sosnick, Chief Strategist at Interactive Brokers. We're here to discuss if traders have become too certain about buying the dips and are at extreme FOMO. It is great to have the both of you with us. As always, Steve Sosnick, we're going to kick it off with you, and perhaps one of my favorite notes that you put out was this Friday referencing Dumb and Dumber. I know every line to that movie, as does my brother. Makes you question how our parents raised us. But there's one line where Jim Carrey's character goes, "So you're saying there is a chance, or you're telling me there's a chance." And it's kind of reflective of what you're seeing in the marketplace right now. Tell us about that.
Yeah. Hi, Jill. I'm glad you appreciated that one. Basically, it's not so much calling the market dumb and dumber. That would be unfair. But I do think the market is taking the Lloyd approach, the Lloyd Christmas approach, which is when he's told that he has basically no chance with Lauren Holly's character. He asks her, is it one in 1,000? No, it's maybe one in a million. And, so you're saying I have a chance. And I think that's the market's attitude to tariffs. If there is the slightest, remotest scintilla of a possibility that some aspect of the tariffs can be postponed or renegotiated, that's the view the market's going to take. We see it today. I mean, on Friday, I was actually kind of shocked that the market didn't end up higher after the Canada tariffs, and yet, we're trading higher as we speak, based on more tariffs with the EU and Mexico. There's only one explanation for that, and that is that the market has decided that these are I don't want to use the taco analogy because that's not necessarily correct here. It's more of just they believe that these are all negotiating positions, and either they'll be negotiated down or pushed back out, and not necessarily paying attention to the fact that we could end up at much higher tariff levels, even if these are not the ones that are implemented. The end point could end up being a bit higher. There was a story today that Brazil, after being threatened with 50% tariffs, which were largely political on that one, said maybe we'll accept 30. Well, that still kind of stinks. I mean, if particularly if you drink orange juice or if you drink coffee, it makes breakfast a lot more expensive. So the market still hasn't really reckoned with this. It's a little, I think, a little too enthusiastic at any wiggle room on the tariff front.
Yeah. Well, Steve Wyatt, there's a couple things in play here. The tariffs at the end of the day could be a short-term solution once we get more clarity, but longer term, we have to think about alliances that are being made. Are we going to be trusted trade partners going forward? The one big beautiful bill got passed, and of course, there's implications there as well. June is kind of one of those months, early July, where it's just a vacuum and it's only macro headlines
Yeah.
or geopolitical headlines. Well, now we're going to get into the thick of earnings, and we know the
Yep.
summertime season of earnings is like a fire hose because it happens in a few short weeks. But
hmm
now we're going to start to hear from management teams, some reality, perhaps.
Some reality, but I think that reality, to kind of Steve's point, is that the imposition of tariffs is not having a huge impact, at least at this point. We're still looking for that impact in the inflation data. We're still looking for that impact in actual economic activity. And so maybe there's a growing sense, excuse me, that the imposition of tariffs is just not going to be as bad as we thought it was going to be. And as you look through that, the possibility that this could lead to even additional economic activity as we get into 26 and 27, I think that's where the market's kind of going. It's kind of looking through this. And look, if Trump comes out and says 30% tariffs on Europe, well, what you know is, okay, that's the cap. It's going to be something less than that. But I do think, from Steve's point, I do think the market is underestimating. We're not going back to 10% tariffs. We have the recent deal with Vietnam. And when we talk about Mexico and Canada, man, a big portion of their imports to us are off limits because of the USMCA. So, I think the inability to quantify just how damaging the tariffs are, the market's taking an optimistic view. And I would offer this, and be interested in getting Steve's take on this. But this is also reflective, Jill, for as restrictive as we think the Fed is, there is still a mountain of liquidity out there looking to do something. And the idea of missing out on AI or whatever it is that is going, that could go right, is just keeping people involved in the game. It's just the fear of missing out is overwhelming the fear of the potential downside.
Yeah. And Steve, this is what you pointed out in your notes as well, that while fundamentals do eventually matter, it's price action and momentum that, momentum and sentiment is going to stay as strong as it is until it isn't anymore.
FOMO and Momo. That's really the short breakdown of this market. And it's working. This is the thing. I mean, we can say, Steve and I can say whatever we want about whether the market is appropriately, looking through the tariffs or inappropriately. At this point, a lot of people have made an awful lot of money looking through the tariffs. And so it would be crazy to think that they're just going to not do that anymore. So, the momentum is so strong. And, Newton's first law, body in motion tends to stay in motion until acted upon by an outside force. So tariffs were that outside force in April. They're not the outside force anymore. As we get into earnings season, which to me, what I'm going to be listening for is Steve makes some really good points about, look, there potentially being boons to economic activity down the road. But in the short term, companies got away last quarter with something unbelievable. And that is, they said, we don't even know what our guidance is. We're going to throw up our hands. The tariffs are too confusing to us. We're going to withdraw guidance, or we're going to hold guidance, or we're not going to update guidance. Any of those in any normal quarter would be death for a company. You'd be talking about 10 to 20% lower. And yet, because we were so oversold, and because the tariff concepts were changing so quickly, the market gave these companies a pass. I would be very surprised if they got a pass again. So they're going to have to say something. And Delta Airlines, I think, was a good example, because prior to, in January, they basically said that they guided to around 735 for the year. Then they withdrew their guidance in April, understandably so. The market didn't really punish them for it. The stock fell, but it never recovered. And last week, they were rewarded for bringing their guidance back to about 575 or so. And so, that'll work for a company like Delta, where the stock was not anywhere near its old highs. I'm not sure how well it works for some of the other companies that are. And to Steve's point about monetary policy, I'm with them 100%. I see no evidence that the Fed, real world evidence that the Fed is too tight. Where you look for that is is there pockets of speculation? Well, clearly, as we see Bitcoin at over 120,000, there's reasons for it from a governmental point of view. Corporate bond spreads are tight. There's certainly no shortage of money flowing into speculative stocks. Based on all that, yes, the interest rate is relatively high, but it's not impeding anybody from doing anything speculative with the money.
Yeah. Well, which is interesting, Steve Wyett, because, clearly the labor market and, the strength of the consumer is, a big part of this equation as well, since we are, an economy that tends to spend a lot. And to read between the lines with, the tariffs are going to impact consumers. We hear so much about the government and how unsustainable its balance sheet is. We've had a number of guests on who their proprietary data, these are point of sale AI companies, where consumer balance sheets, the data that they're seeing is stronger than it's ever been. So we keep hearing about these headlines that, the consumer is not going to be able to participate, but their balance sheets are relatively quite clean and they continue to spend.
It all depends on where you want to start your, what your comparison is. If you're going to go back to during the pandemic, when the federal government was passing out $6 trillion, their balance sheets don't look as good then. But if you go back to before the financial crisis, there's been a significant amount of deleveraging on the part of individuals that does put them in a better position. It's all, look, we can point to areas. If you're in the bottom 50% of income earners, look, it is the aggregate impact of inflation. You're feeling that, and that's been very difficult. That's been very difficult to overcome. But when you start looking at the broad numbers, it's not as negative as what someone would lead you to believe. Again, it just depends on where your starting point is for your comparison. But I think that all of this just points to the fact we got unemployment at 4.1%, Jill, and I know that there's a case to be made. You look around the edges of the labor market, continuing claims continue to remain high, even as weekly jobless claims remain low. But I think that we're starting to see some impact from the much more aggressive stance on immigration as foreign-born participation falls. We're starting to think about what does that mean to the labor force, and we may actually be seeing unemployment that remains low because of some shifts happening there. So there's all this. If I'm the Federal Reserve and Jay Powell, I can build a case either way for which way this is going to break from here. But at this point in time, if you just look at, you guys are up there in New York, I'm here in Tulsa. I'm just telling you, there's no recession at the restaurants in Tulsa. There's no recession at the shopping centers here in Tulsa at the present time. So as I travel around in the different markets, activity still seems pretty good on an overall basis.
Yeah. Steve Sosnick, what's that old saying? If your neighbor loses their job, it's a recession. If you lose your job, it's a depression. So it really is all relative.
Yeah, it is. And I think what we're seeing is to just amplify Steve's point, I think it's a K-shaped recovery. Those at the higher end of the income distribution are doing quite well. And many of them just found out that they're going to be doing even better from a tax point of view. If you're at the lower end of the economy, it's not quite so clear. Things are pretty murky. We don't really know the full effects of how the labor is going to shake out. But to your point, my wife and I were on Long Island yesterday visiting my parents, and we went to one of the malls there, and it was packed. I thought it was like Christmas. It was so crowded. So again, it's an upscale mall. That's the higher end of the K recovery. But I think from an investing point of view, for better or worse, it's the higher part of the K, it's the upper part of the K that does most of the investing. But ultimately, with the consumer being 2/3 of the economy, if you have if the consumer as a whole is unhealthy, it's problematic. But as of now, the companies have not really the tariff effects have not been terrible, and they've not really been passed on yet. I think consumer sentiment surveys have tended to stink. They've gotten a bit better, but still not good. But we're going to learn a bit more this week as we get CPI tomorrow, PPI on Wednesday, retail sales on Thursday, and then as the earnings start to roll out. I tend to not focus too much on the big banks because they're too fluky. Who else other than banks and other financial companies? You don't really care about the shape of the interest rate curve or trading profits or any of that sort of stuff. But you do want to listen to when their management speaks, because they see customers large, small, and everything in between, and you want to hear what they have to say about what their retail and corporate customers are doing and their trends, and that gives you a clue maybe to what to expect during earnings season.
Yeah, and Steve,
the other thing, of course, on that, Steve, from a banking standpoint, is watching what's happening to their credit costs, what's going on in their note case, and in that respect, we just continue to see very low credit costs across all of the banks. I would just tell you, for my bank, we're a $50 billion bank. We got a $35 billion loan portfolio. Our credit costs each of the last 2 quarters, 0. Which is just almost unbelievable to have a note case of that size. So credit costs remain low. That's to your point. The underpinnings of the economy, if you start thinking about where the stumble could come from, what I would say is we've taken a few body blows with tariffs and some other things. It just appears we're still standing and an ability to continue to move forward at this point from an economic standpoint.
All right. Appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks. Thank you, Jill.